Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 18th, 2017. I wanted to do an update to the financial sector. That is an active trade on the site, at least via XLF, the ETF for the financial sector. That was put on about a month or so ago, right about the time we broke down from this bearish rising wedge pattern. Pretty timely entry. And that one went on. The financials had pretty much a waterfall sell-off, as you can see there, in just a matter of a couple, like maybe less than 2 weeks. It looks like we went on to hit that first target back here on March 27th. We hit a low of 22.98, so that hit the first target here of T1. And the reason I list multiple targets, this can also be found in the FAQ page. The reasoning behind multiple targets, there's several reasons. Some traders may prefer to just take quick profits and run. Maybe you're a more active swing trader. Other active traders might be holding out for more downside. I still have this potential third target down here around 21.50. And now the thing is, with each price target on a short trade, those are support levels that I believe a reaction, the odds for a reaction, meaning a bounce or a consolidation, we had both in this case, is very likely. So you could have covered reverse long if you're a really active trader. We went back up to this resistance level here, fell back down. Now here's where we're at. We've been flirting 3 days. You can see 3 candles off the support level, and the actual support level, keep in mind, that's at 22.94, at least the line I have here. I always list my short targets a little bit above the actual support level to avoid missing a fill. So where we're at today, this doesn't look good. The PPO looked like it was turning up here and it's moved back down. Both are still pointing lower, the signal line as well as the PPO line. We are oversold, and that therefore the odds are now elevated at this point for a bounce because we're still on that support. So far that support has held on that first test and for the last 3 days. Oversold with the RSI recently crossing below the 30 mark. That's another reason. You can see the last time we were oversold on the daily chart was right here. Back when I pointed out this inverse head and shoulders pattern, and you know, that was the last time when the right shoulder was put in, we were oversold. Before that, it was a formation of the head. You can see positive divergence down there, a little higher high. And then on the left shoulder, which that flash crash did happen. There were some prints down there, but it was very brief. And so as far as the symmetry for that pattern, I exclude that long candle. But again, that did occur that day. So there it is. We've come full circle. The measured target was hit and then some, which indicates this move may have run its course because we've already exceeded the measured target for that inverse head and shoulders pattern. As I pointed out in the last video, this line here is the widest part of the wedge. It's a very simple but fairly effective tool to measure, to give you a guide of how far a stock or a index or ETF may fall on the breakdown below a bearish rising wedge pattern. And that lines up very well with that potential third target, which is also, I have some levels there. There's a big gap shortly after the election. So where I'm going with this is, as of now, the odds are elevated for a bounce because we've defended support. And now what I just did is click down to a 60-minute chart. You can see up here on the left, hourly. And as I pointed out in the trading room when I was asked my opinion on the financials, there's certainly if this level does hold, and so far it has for a few days, we may see a bounce here. You can see the positive divergence on the indicators. I have the MACD, the RSI, custom histogram that defines the trend. When the histogram is red or below 0, that's the 13 and 33 EMA pair. The trend is bearish, as it has been for a while. And when it's above, when it's green, it's bullish. So we're close. We could cross over soon. And more importantly, watch this downtrend line if you're long or looking to get long, or I should say short or looking to get long. I took a little bit off today. I did reduce some exposure because of that, but that also had more to do with I had some puts that expire this Friday, and at this point I usually don't let them ride so close to expiration. They, nice gains in those, but I'm going to close those out, and I'll keep for the time being, a short position on FAS. Now, if this breaks out, This 23.85 all the way up here to about $24 or so, that would be my expected bounce target. And I want to reiterate that I still think there's a good chance that the longer term downside targets might be hit. It's just a matter of what's your trading style. If you're comfortable, if you got in here when we broke down, you're very profitable. And as long as we don't go much above that $24 level, you'll remain profitable. So this is where you need to define your time horizon and trading style. Do you want to try to game every little bounce? We may not bounce, even though we have the positive divergence, and I want to just point that out. You can see prices making a lower low here from this point. So those are all the positive divergences, again, that show through on the 60-minute chart. And that's one scenario. It's possible we break above this downtrend line and don't make it that far. I just recently pointed out bullish falling wedge pattern on the 15-minute chart on QQQ, and it popped, but so far it didn't go very far. And that will show you a change in character in the market, because if we are still in the early stages of a new downtrend that has much more downside to come in the market, what will happen is bullish chart patterns will tend to either not play out at all, or when they trigger an entry, the move will be a lot less than it would be in a bullish uptrend. You'll see more failed breakouts and a lot of chart patterns that don't reach their measured move. So again, this would be my uppermost scenario, and at which point I would be concerned, and it wouldn't completely eliminate the longer term bearish case, but it would certainly dampen it if we start to get above that $24 level, the white line right there. So that's what I wanted to point out. And if you're bullish on the market overall and bullish on the financials, this is a great buy point for you. Wait for a breakout of this, or go long right here. We're just above the support around the $23 area. You can go long with a stop not too far below, and shoot for new highs if that's your thing. Again, my take is a little different. Let's look at the weekly chart. I'll kind of show you some of the evidence. You know, this is 10 years, a 10-year weekly chart. And in the last decade, we've had 3 divergent highs on the PPO, RSI. You can see here prices making higher highs. They're all drawn out. You look at the uppermost line that shows you prices making higher highs, with the indicators and oscillators making lower highs, i.e. negative divergence. So we had negative divergence at this point. That was followed by a 36% drop. We had negative divergence right here at this high. That was followed by a 27% drop, pretty swift one. We had negative divergence here. Now, it wasn't nearly as long in duration as these previous 2 divergences. However, we had some extreme, rarely if ever seen overbought conditions. And when you zoom in, you can see the negative divergence. I didn't draw it out here, but it was definitely there at that high. And so far, we've only come down about 9% or so. If you want to know where I think we're going, putting any short-term bounces or squiggles aside, I think in time there's a good chance we come all the way down here to this level. It's about 20, either the trend line or that horizontal line. If we had a waterfall sell-off, we'd get there soon, and then we'd have intersecting support, which would be a great long entry right there for the financials. But we may come in and hit this trend line first, bounce there, and let's see, that horizontal line, to give you an idea, is about 2080. Okay, so that's a potential downside target for XLF. And going back to the daily chart, you can see again it roughly lines up with that $21 target area right there, potential T3. As of now, I might pull this one early tomorrow, because the downside to T2 is not that much in percentage terms. You're talking about a half point, roughly 50 cents. We have that bullish divergence, but longer term it still looks bearish. So unless stated otherwise in the next day or two, this still remains an active trade, and I just wanted to kind of point that out to you guys. Maybe lighten exposure, or if you think we're going down, then just lower your stops to protect profits. We shorted way up here around 24.70 or somewhere around there, and we've got a long way to go to get back there. So the financials have rolled over. I put a note here. I made mention of this in the trading room at the time. There's an article that was published in the Wall Street Journal, and let me give you that here. This is the Wall Street Journal. This article was published back on March 1st. Ironically or not, I think not, that's the exact day the financials peaked. And the headline was, "Bankers are more upbeat about banks." I mean, where was this headline on November 6th or even November 6th, where the election, so the votes were tallied, and we knew by November 7th. Now, Trump wasn't in office yet. He'd only been elected, but we all knew where he stood. And, it's just ironic. The banks rallied about 25%. They've already given back nearly half of that now. So this would have been a more timely headline back then. But, of course, it's the same story as what was it, Time Magazine back a few years back. They're famous for putting out bullish headlines at market tops and bearish headlines at market bottoms, and I just thought that was funny. And again, that only strengthened my resolve on the financial short when I saw it. All right, let's dig into the charts and we'll wrap this up quick. So the 60-minute chart again of XLF, this is what's giving me pause in the short term. But if this is foiled and we break below support, that's roughly 2290, call it 23. And again, it's that same first target level there. If that breaks, we go down to the next target, 2252. Here's another support level, potential target at 2180, and then that longer term target there around the 21. Be safe a little bit, cover a little bit above 21 if we get down there. And we'll take a look at a few of the top components and we'll just wrap this up. All right, one of the largest financial stocks out there is Berkshire. And let's just compare it to what's happened since the video. Okay, here's the video from, again, a month ago yesterday, March 17th. There was Berkshire, a very clean bearish rising wedge. As I said, I mean, these patterns just don't get any better than this in technical analysis. These were clean divergences, just as we had divergences back here, and those divergences played out for correction. Nothing is 100% in trading, but all you can do is try to recognize these patterns, take the best looking setups, and trade them. You have to hold your nose. And the financials were, screaming at all-time highs. Everybody was uber bullish, but that's when you want to be shorting. You don't want to be buying after a 25% rally, and when sentiment is as bullish as it can get, and it's over, lopsided to the bullish side. So as of today, you can see where we were back there, 172.96. We had nothing short of a waterfall sell-off. However, we're coming up at support. I added this line since it's about 162.25, give or take. This was the other target I had on Berkshire down here, and I still think it'll be hit, 159. And this is my if things get ugly target down here. And I'd like to go through these components because I truly believe you'd be remiss if you're trading a sector not to focus on these big components, especially when you have a sector that has some very top-heavy mega cap stocks like the financials. So this gives a good guide as to where we're going. However, we look at the 60-minute chart. Here's a nice, clean, bullish falling wedge confirmed with bullish divergences. So, as I said, these may or may not play out. I certainly wouldn't be aggressively short at this point. As I mentioned, I did take some profits off the table and some long exposure in the sector. And if these break out, then you can see there's a line there. That's a potential target. Next target would be up here around this level. You can just correlate these with the numbers on the chart or replicate your own charts. And of course, if you're a member of the site, you're watching this is a member-only video, just shoot me an email or a line in the trading room if you're trading any of these individually, and I'll be more than glad to mock up a chart and give you some price targets and stops and things like that. So there's Berkshire. Next one up, JPM, JP Morgan Chase. Big company. Here it is. We have a trend line here. I need to brighten this up a little bit so you guys can see it. I think this is an important trend line to watch. We have an uptrend line, numerous reactions. So you have a stock that's already corrected, fallen down to both trend line support as well as horizontal support. This line, of course, right here is a horizontal support line with a couple reactions there. So intersecting support, maybe a little downside tomorrow morning. But again, remember, if this is the start of much more, this is the typical, what we typically see in a correction is that those early support levels where in an uptrend, this is where you want to buy a pullback to support. I mean, I would go all in right now long if I thought this market was going to new highs. And maybe it does, but and this is where you'd buy a pullback to support. However, if this is a start of something more in both the broad markets and the financial sector than what you would expect is the nearby support levels to get smashed through as if they're not even there. And that will show a change of characters if the dip buyers do not step in here and JP Morgan takes out both of those levels. I should have started with the video again. This was the March 17th video. There was that bearish rising wedge, horizontal support as well, and that, which is again a very clean short. And I'm also doing this because there is a lot of correlation in the sector with these big names. Birds of a feather flock together. So, you know, again, if we can identify multiple stocks coming to support, that's how much it's fallen. Then that gives us a heads up. And again, maybe the support levels get smashed. I would have no problem adding back the short exposure that I reduced today if that is the case. Wells Fargo, another big one. This one's just had a waterfall sell-off. Let's just take a look at the video real quick. Or I should say the previous video. So here's where I pointed it out. We had just broken down from that steep bearish rising wedge. And if I remember correctly, I might be wrong, but I typically talk about this in videos. The steeper the wedge, the more powerful the fall, the sharper the fall. And that's certainly what happened with Wells Fargo. Look at that waterfall sell-off. I mean, from that point there, that's about where I did the video and highlighted it. It dropped about almost 14%. Had a little reaction in between. In fact, this looks like a bear flag continuation pattern, maybe a bearish pennant, and that would tell me this stock has probably run its course at least for the time being. If you take the flagpole, which is the impulsive move leading down to the pennant or the flag, and you add that to the highest point of the flag where it broke down, that gives your measured target, and that's about exactly what we hit. This was an old stop on an old trade that got taken out. And there's also a lot of support. You see all these reactions back here. There's one that if I were still short, and I don't believe I shorted Wells Fargo personally, but if I were, I would have covered on this red line, or I'd cover today if I didn't already. I just wanted to say that anything can happen, but the risk reward is no longer favorable to remain short in this one. There's just simply not a lot of meat left on the bone. And if you think the sector is going to reverse, or you even want to play a bounce trade, there's a possible long for you. Let me look at the 60-minute chart. I don't have it marked up, but you can see, I'll move that line correctly. Just same story, guys, down the line. I won't draw on all. You can do it on the histogram as well. And then you can see a pretty steep downtrend line there. So there's your buy signal. If it takes out that downtrend line, this shows you the divergence right here. So there's a potential long. And again, if you want targets, just drop me a line in the trading room. All right, let's move through the rest a little bit quicker. The same story. You're going to see all these have fallen off. I won't jump back to the video anymore because we know what happened. There's the rising wedge. There's the breakdown. There's Bank of America. Also had this ascending broadening wedge pattern defined by this white line, if I can grab it. That white line and that white line make up an ascending broadening wedge pattern. We broke, back tested it. There was also horizontal resistance. That was a very objective short. And there's support here. We've reversed just shy of that level 2 different times. So at this point, we'll have to say that's probably another support level, or we'll call this a support zone. However, like a lot of these financial stocks, there's a lot of thin air beneath it. What I mean by thin air, I'm talking about well, one way to look at that is the volume at price histogram. Let me turn this up for you. Okay, so what we're looking at here are the red bars. You see these long red bars, you see a lot of green and red bars, I should say, the histogram. In between, it's very thin. A thin zone just means that there weren't a lot of trades in this period. Let me try to get a box here. So this is our thin zone right here, where there weren't a lot of trades because this was the Trump pump. Not many people got on board. We ripped up so much, so fast. Most market participants were caught off guard. And thin zones are very similar to a gap, if you will. Gaps have absolutely no trades between at that point. Thin zones have very few. So where the similarities lie is that once a thin zone is entered from above, it is very often backfilled, just like a gap. And not only that, there's a vacuum there. There's not a lot of trades, so prices tend to fall rather quickly. So this is a potential scenario for the markets, and I can promise you, if you see a big meltdown move in the financials that backfills those thin zones, and they're all going to look very similar because that's the Trump pump there, you're not going to see the broad market moving up at that time. That's about there are no guarantees in the market, but that's about as close as I can get to giving you one. So just something to watch for. And again, we may bounce, we may reverse. Who knows? Maybe we go into new highs, but right now, at best, near term, cautiously bullish, but very much open to the door, open to the possibility, I should say, that we don't bounce much from here. Here's Citigroup. Citigroup, here's a large rising wedge. If you look at this line and this trend line, we broke down, back tested, and Citigroup's hardly even, this wedge pattern hasn't even barely played out. We had to break down the back test. Citi, in my opinion, has more meat on the bone on the downside. We have at least this target here. I would expect a little reaction there. And then if that level goes, here's our thin zone, guys, right here. There's the Trump pump. I'll circle it for you or highlight it for you. And this would be if things get ugly. And that would mean a drop in Citigroup, you know, one of the world's largest financial institutions, another 14 or so % downside from current levels. So something to keep in mind. All right, GS, Goldman Sachs. In the video, I had these two levels marked originally as price targets. During the video, I added this line here. We had some reactions. We hit that first target, or reversed just shy, bounced, had a reaction around that level, and moved down, and now we've hit that second target. Effectively, you know, not to the penny, that's a $213 share price. We hit a low today of $213.18 versus my target of, or actual support of $213.65, which is statistically, we hit it. I mean, I'm talking basis points there on a $213 price. Stock price. Where do we go from here? Well, same story. You know, we have the divergences on the 60-minute. They're not all drawn out here. You can see it down below. So, you know, if these stocks are going to bounce, if they're going to rally, and even put in a bottom here, if the correction is over, so certainly some of these, such as Goldman, this one may have played out. If I take a wedge measurement here, measure the widest part of the wedge. Let me try to do it like this. This isn't exact, but it's give you a rough idea. That one's pretty much played out to its expected move. So the bottom may be in some of these financials. Like I said, I'm kind of open to any scenario. Have my concerns about the broad market. I'd be odd to see the financials bottom and the broad market continue lower from here. Gold or USB, we certainly hit, and there's that target I had, that horizontal line, and we closed just a hair below it today, but not close enough to say that level's been taken out with conviction yet. Again, it was a beautiful bearish rising wedge pattern, impulsive selling, and hope a lot of you guys caught some of these. And here's that thin zone. So if things get ugly, even if we get a reaction first, we may or may not, but if we fall into that thin zone, this is where we're going down, most likely to that 46 level. And if, you know, if things get ugly, we're in earnings season. Anything can happen. You can have some negative surprises. I know there's some pretty lofty expectations for this earnings season. So just be on your toes. Be ready to move. Have a plan A and plan B in trading. That's all you can do. All right, a couple more and then we're done. We covered, the last two we covered in here were MS, Morgan Stanley, as well as AXP, which I'll get to next. There was a bearish rising wedge pattern. Confirmed with negative divergence. See, we had looks like a wedge here, but we didn't have negative divergence at that. Actually, we did, and it never played out. Trump pump foiled that. And these are some of those examples that you hear. Sometimes the technicals do trump the charts, no pun intended, but that's what happened there. You know, obviously the markets, we talked about it in the last video, markets had priced in a Hillary win, and her views on the financial system and the banks are a lot different than Trump. So, or at least in his rhetoric, we'll see what happens. Anywho, this is a stock flirting below support right now. This was a support line pretty well defined. We pierced below it one day the first time we went down there, recovered it, and we moved back below. So this one is in a precarious technical position. I don't see the, at least on the daily chart, the PPO is still pointing lower. About the only thing it has going for it is it's oversold. But remember, as I often say, oversold can become more oversold, or it can stay oversold for an extended period of time. So oversold by itself is not a reason to go long. It's not a buy signal. It is a caution sign that, hey, the stock's probably it's getting a little stretch and it may be due for a bounce. And the last one here that we covered was AXP. American Express, ascending price channel breakdown, and this one seems to have hardly played out at all. It's certainly down. I mean, it's down off the highs. I don't know what it's at, about 8% or so. And these are potential targets down here. I'm not looking for this line, but if things get ugly, I could see us going down, maybe down here to about this level here, and that is, we'll call it 67.50. But again, these guys are going to move together. Birds of a feather flock together. So that's what I'm watching for. Let's watch those 60-minute charts. Let's watch the broad market and watch these support levels a lot of these stocks are at right now. So they're oversold at support. And if this market, especially the financials, have a lot of gusto left in them and they're heading to new highs, this is the time they should reverse. If they don't, then that shows, again, it shows a change of character in this market. With a shift to more sellers than buyers. Okay, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.